Welcome to the Deep Dive.
Glad to be here.
Today, we're diving into a stack of recent updates from Fund at Mental. They're these quick snapshots, really, of shifts happening right now. Economy, geopolitics.
Yeah, they're great for getting a handle on things quickly, short, timely pieces.
Exactly. And our mission, basically, is to quickly unpack the key insights from these for you. Hit the points that, make you stop and think a bit.
Sounds good. They often connect things you might not immediately link together. Gives you a sharper view.
All right, let's jump right into the first one then. It's titled 8-3. And what hits you immediately is this huge contrast. Central banks, right?
Mm-hmm.
The European Central Bank, the ECB, they've been cutting like crazy. 8 times in the last year.
8 times, wow.
Yeah, bringing their rate down to 2.15%. Meanwhile, the Fed over here...
Much slower.
Way slower. Only 3 cuts in that same time frame.
So you'd normally think, okay, higher U.S. rates compared to Europe, dollars should be stronger.
Right.
That's the standard thinking.
That's what you'd expect. But the piece points out something really surprising. The euro, it's actually appreciated significantly against the dollar.
Appreciated, even with fewer Fed cuts.
Yeah, something like 11% year to date. It's quite a move.
Okay, so what's the explanation there?
Well, the article suggests, and this is the key takeaway, that maybe the sheer weight of U.S. debt and, the deficit, it's starting to matter more than the interest rate difference.
Ah, so investors are demanding a higher yield, a premium, just to hold dollars because of those fiscal concerns.
That seems to be the implication, like that risk is weighing on the currency. And speaking of the Fed, they've got that meeting coming up soon, right? June 17th, 18th.
Mm-hmm. Any action that's expected?
Nope. The expectation is they hold steady. But the source does note, expect some political noise about the Fed maybe moving too slow, especially given what the ECB is doing.
Right. It does raise questions, doesn't it? If the old rules about interest rates and currency strength aren't holding up because of these bigger fiscal shadows.
Definitely makes you wonder. Okay, so moving from currencies, let's talk markets. The next piece, April showers, May flowers.
Catchy title.
Yeah, but it sort of flips the old saying, sell in May and go away. It seems like the selling actually happened back in April this year.
So markets are down in April.
Yeah, and now, looking year to date, the major indices are pretty much flat. But flat doesn't mean calm, right? It's been volatile, choppy.
And does the source point to reasons for that choppiness?
It does. It points to just general uncertainty, questions about the U.S. economy's direction, global trade tensions, the usual suspects.
Okay.
But they also drop this interesting detail, M&A activity, mergers and acquisitions.
Yeah.
It's apparently at multi-decade lows, like really low.
Wow. That's often seen as a sign of confidence or lack thereof, right?
Yeah.
Companies are hesitant.
Exactly, and the article kind of puts these pieces together, the M&A slowdown. Plus, they mention warning signs from the bond market and the dollar that seem to be, ignored.
Ignored warning signs,
Yeah.
Never a good feeling.
Right. They see it all as maybe pointing towards a potentially much more volatile second half of the year, a bit ominous. And they also mention the upcoming tax plan, which is expected to increase the deficit further.
So more fuel on that deficit fire we were just talking about. It all connects.
It really does. Which brings us nicely to the next piece, actually titled Dollar Pressure. This one dives even deeper into that.
Okay.
And it mentions something, pretty wild sounding, a proposed Bitcoin Act of 2025.
Bitcoin Act. What would that do?
Get this. It could potentially allow the Fed to revalue its gold reserves. Basically, mark them up to market value.
Okay. The Fed holds a lot of gold, but it's on the books at a very old price.
Right. So revaluing it would, on paper, create something like $800 billion.
Just like that. $800 billion.
Yeah.
And what would they do with that theoretical value?
The proposal suggests using it to back Bitcoin reserves.
Hold on. The Fed holding Bitcoin reserves backed by revalued gold. That's unconventional, to say the least.
Highly unconventional.
Yeah.
But the article connects this sort of policy trial balloon to what's actually happening in markets. There are these really significant flows moving into alternative assets.
Like crypto and gold.
Exactly. It mentions gold funds saw a huge inflow just last week, something like $8 billion.
$8 billion in a week into gold. Okay, so people are looking for alternatives or hedges or something.
Seems like it. And all this is happening while the trade-weighted U.S. dollar is hovering near its low point for the year.
Back to the weak dollar despite the Fed rates.
Yep. And the article again points to maybe two things driving that. One, the administration might actually want a slightly weaker dollar for trade competitiveness.
Makes exports cheaper.
Right. But two, it's that persistent weight, again, the debt and the deficit just dragging on it. The source has a great phrase for this whole situation.
What's that?
They call it playing with fire.
Playing with fire. Yeah, I can see that. Trying to manage currency goals while you've got this huge fiscal issue underneath. It sounds risky.
Definitely. Okay, let's shift gears now. Completely different topic, but connected through trade and global strategy. Korea's new chapter.
Ah, geopolitics. South Korea.
Exactly. They had elections recently. And the result, a new president who's seen as maybe more leaning towards China.
Okay, and that's significant because South Korea is right in the middle of that whole U.S.-China competition dynamic.
Hugely significant. The source really emphasizes how critical South Korea is strategically. They call it a linchpin for the U.S. in the Indo-Pacific.
A linchpin. Well, how so?
Well, for containing China, obviously, but also vital for intelligence. Think about their proximity to North Korea.
Right, crucial intel source.
And economically massive, a huge trading partner, something like $192 billion in trade. And then there's the tech angle.
Semiconductors.
Memory chips, specifically. The source says South Korea supplies about 60% of the global market.
The 60%. Wow. So any political shift there has massive ripples.
Absolutely. And the article even throws out some speculation, wondering if recent U.S. tariffs might have actually played a role, maybe unintentionally, in pushing the election outcome that way.
Interesting thought. Cause and effect across different domains?
Yeah, a domestic political event with potentially huge global economic and strategic fallout. Okay, let's bring it back to the markets with paradigm shift.
Paradigm shift. Sounds big.
Well, the article points out something pretty stark about market performance this year, 2025. So far, U.S. markets are significantly underperforming the rest of the world.
Underperforming? How much?
It's apparently the widest gap year-to-date since way back in 1993.
Since 93. Okay, that's notable.
Yeah.
So is it just catch up for other markets or something more fundamental?
That's exactly the question the source poses. Is this just about valuations evening out? The U.S. was expensive, now others are catching up? Or are we actually seeing the start of a real paradigm shift?
A shift away from the U.S. as the automatic go-to-market leader.
Potentially.
Okay.
And guess what they point to, again, as a potential factor?
Let me guess. Debt and deficit.
Bingo. Those clouds of debt and deficit, as they put it. But there's a twist. They also raise this kind of counterintuitive idea. What if the conflict in Ukraine escalates further? Could that ironically drive a flight to safety back into U.S. assets, even with the underperformance?
Huh. So a geopolitical crisis could temporarily reverse the market trend, even if the underlying issues remain. Interesting dynamic.
Very. Now let's talk about the data that underlies a lot of this economic discussion. The piece puzzling.
Puzzling. Okay, what's puzzling?
Well, first, it mentions that recent ADP private sector jobs report. Remember that one? It came in way, way weaker than anyone expected.
Right, I recall that. The forecast was much higher. What were the numbers again?
Expected was around 137,000 jobs. The actual number, only 37,000.
Oof. Yeah, that's a big miss. A sign of slowing, maybe?
Could be. But the really puzzling and maybe more concerning point in this piece comes from a Wall Street Journal article they reference. It's about the quality of the official inflation data.
The CPI, you mean?
Yeah.
What's the issue?
Apparently, due to changes in how they collect the data, less field collection, more estimation.
Estimation.
Yeah.
For inflation data.
Yeah. The source says nearly a third of the items in the index are now estimated rather than based on directly observed prices.
A third estimated. That sounds problematic.
It does. The source notes this makes the data potentially less accurate, definitely more volatile, and raises some uncomfortable questions about, well, potential manipulation.
If the core data we rely on for policy decisions is becoming less reliable, that's a fundamental problem.
Wow. Exactly. It makes you question how solid our picture of inflation really is. Which leads us to the final piece, tick-tack.
Like a ticking clock.
Seems to be the implication. This one looks at the PCE inflation number. That's the one the Fed supposedly prefers over the CPI.
Right, the Personal Consumption Expenditures Index. How did that look?
Actually, it came in a little better than expected. Year over year, 2.1%. Core PCE, stripping out food and energy, was 2.5%.
Okay, 2.1%. That's pretty close to the Fed's 2% target. So
technically, the article says, the Fed could probably justify starting to cut rates based on that number.
But are they going to?
The source puts the odds of a cut in June or July at basically zero. Maybe September is the earliest possibility, they reckon.
So even with PCE looking better, they're holding off. Why?
Well, the piece raises these bigger forward-looking questions like, okay, PCE is behaving now, but what about the potential impact of major new government spending plans, like the OBBB Own Back Better bill mentioned?
Ah, the fear that more spending could reignite inflation.
Exactly. Then there's the other side. Could tariffs or a global trade slowdown actually tip things into a recession, which would counter inflation?
So push and pull forces, inflationary spending versus potentially recessionary trade policies.
Right. And can private investment, maybe driven by things like AI, generate enough growth to offset all this? The source seems pretty skeptical.
Skeptical, meaning they think growth won't be enough.
They suggest probably not. And they point to rising bond yields as a warning sign and basically warn that a fiscal bomb is ticking away.
Tic-tac. The fiscal bomb. Doesn't sound good.
Not really. Okay, so let's try and pull this all together. We've looked at, what, 7 different snapshots here?
Yeah, quite a few different angles.
And the picture you get is, well, it's messy, isn't it? Really complex. There are all these conflicting signals flying around.
Definitely not a clear, simple story. You've got inflation looking maybe okay by one measure, the PCE.
But then serious questions about the quality of inflation data overall and weak jobs data from that ADP report.
Right. And markets are volatile. The U.S. is lagging significantly behind the rest of the world for now.
But maybe due for a safety bid if geopolitics heat up further.
Could be. And speaking of geopolitics, we see shifts in key places like South Korea impacting trade and strategy.
And hanging over absolutely everything is this massive, persistent shadow of U.S. debt and deficit. It seems to be influencing the dollar, market sentiment, future policy, everything.
It really underscores how interconnected all these things are, doesn't it? You can't look at monetary policy without considering fiscal policy or markets without geopolitics. It's all woven together.
It absolutely is. And for you listening, navigating this landscape requires seeing those connections. So maybe the final thought to leave you with, based on all this, is about those signals. Given the serious questions these sources raise about data accuracy, about the overwhelming weight of debt, about these big global political shifts, how much faith can we really put in the traditional economic signals anymore?
Yeah. Are the old indicators still telling us the right story? Or is the rule book changing?
And what does it mean when, as one source put it, warning signs from really important markets like bonds or the dollar seem to be just brushed aside or ignored? What happens next?
That's the multi-trillion-dollar question, isn't it? Food for thought.